So, good afternoon, everybody. Welcome to the 6th in our summer series of auditing webinars. And this one is on the auditor's expert. But I'm wondering how rapidly we should get into the detail because the number of people who've logged on is a little bit lower than we would expect by 3:30. I suppose that's their loss if they're going to be late, isn't it? So we will get back to the slides, which some of you will have been gazing at for several minutes now. And that should be the first slide. And go on to what are we going to talk about this afternoon? Well, first of all, we're going to talk about who is an expert, which oddly enough is not quite as straightforward a question as you might expect, because we have things like consultants, and then we have management's experts, and we have auditors' experts, for which we have an entire auditing standard, ISO NZ 620. Then we'll look at what the FMA has found and what the FMA expects. Now, this, of course, only actually applies to licensed auditors, but there are some licensed auditors amongst the audience. And there are, of course, others who may be using an expert and want to know what's the best thing, how is it to be done properly. So we'll start about what do you think is an expert? What experts have you used? So I'll leave the slide up on the screen for a little while, although you should have it in the handout. Think about the experts that your clients have used, or indeed experts that you have used, but mainly the client's experts, and chuck that into the chat box. And I'm going to have to, okay. Valuers, actuary. A client who used an actuary. Actuary is plural. Oh, that gets fun. Okay, yes, a plural. Please chat to everyone, not just to the panelists. You do have an option in your chat box to a little drop-down menu. Property valuers and specialist accountants. Aha. A forestry valuer. Yeah, there are a few of those around. They are often involved in audits because there are quite a few forestry companies, forestry partnerships that were issuers under the old regime and are now FMC reporting entities. So we've got forest valuers generally, forestry valuers in particular. Congratulations, Chris, for chatting with everyone. And actuaries. I wasn't expecting actuaries to come up in, but there are some good examples there. And now, I'm getting ahead of myself. So we will. So your clients now. So experts that you have used in the last year. So this might get a somewhat different answer. So our clients have used actuaries and forestry valuers. Who have you used as an expert in your role as the auditor? I might have to stop sharing too. So. Wow, valuers, solicitors, tax specialists, barristers. That's wow. tax advisor, fishing quota valuer, property valuer. Bill Heritage. Bill Heritage as an expert. Well, actually, that will come up as an interesting one. None? Yeah, that's okay. This is allowing me to gauge the extent to which the audience is using tax experts, forestry valuer. Does anyone else want to think about it a bit longer? Any more? Accounting and tax specialists. Okay, we'll go back to the slides, and you probably don't have the next slide in your handout because I was very sneaky and I didn't let you, cheat. So these are the areas of expertise that I was expecting. Tax, and yes, indeed, we got tax. Property valuations, value was unspecified. I'm expecting were probably property valuations. Forest valuations, yes, I guessed that one right. Livestock counting and or valuations. Now I know a number of auditors who have audited numbers produced by stock agents who were livestock experts. No one mentioned it today. And valuations of shares and other financial instruments. In my role as an FMA quality reviewer, I came across a number of these done by treasury accountants, and I confess that I'm highly skeptical of valuations, and my role as a reviewer didn't do much to reduce that skepticism, alas. So these are the kind of experts. I did think of actuaries, and I didn't think anyone would have that, but there you go, you proved me wrong. Okay, now who is not an auditor's expert? Because there are actually some exclusions. And the first one is an expert in accounting or auditing. So Bill Heritage might be an expert. This is a rumor, but he's not an auditor's expert because my expertise is in accounting and auditing. So I'm not an auditor's expert. We will talk about what I am instead. And the other one is a management's expert is not also an auditor's expert. This is highly theoretical because I've known many instances when management and the auditor have relied on the same expert, but we will see what the standards say about this. So, an expert in accounting or auditing. So that's financial reporting experts, auditing experts. One of those is a consultant. It's okay. It's not a case of, oh, I'm not allowed to use an expert. Absolutely, you're allowed to use an expert in accounting or auditing on your audit, but they are a consultant. They are not an auditor's expert as defined. And of course, the people who write the standards are very fussy about these things. And consultation is not governed by ISO 620. It's instead comes under ISO NZ 220, and it will of course be in your own quality control manual and your auditing policies on when to seek consultation and how to handle it and so on. So whilst consulting with an expert on accounting or an expert in auditing does not come under ISO 620, you might think that in fact the requirements of 620 are sufficiently useful that you might voluntarily follow them, or most of them. So there we go. That's what an expert in accounting or auditing is. So when you go to your tax partner for expert advice, that's an auditor's expert. If you come to Tupisa Limited for advice on auditing or financial reporting, you're recruiting a consultant. We've got to get these things straight. So, a management's expert. How do we tell a management's expert? One, well, the management's expert has not been selected by the auditor. They've been selected by management. And then the use of information provided by a management expert is governed by ISO 500 evidence, audit evidence. And that's what a management expert is, and we will have more to say about them in a little while. But first of all, we will look at consultants. Okay, we have consultants. Having a consultant involved in an audit is really quite common, and it is the engagement partner's responsibility, which cannot be delegated or abrogated, to ensure that appropriate consultation is taken on difficult or contentious matters. And with Topisa Limited, most of our inquiries, most of the consultations actually come from engagement partners, but not always. Sometimes we get a question from a manager, but it's the engagement partner's responsibility to ensure that consultation is taken on what your team would regard as difficult or contentious matters. Now that, of course, what is difficult and what is contentious will vary from audit to audit with things like the qualifications and experience of the people on the audit team. If I, for example, were to be the engagement partner on the audit of a bank, and I don't think I'd be so foolish, but I would have to say that my experience of auditing banks, which is not zero, but was a long time ago and a very junior level, would require considerable consultation with those who knew more about banking, modern banking. So, if we have a consultant, the nature, scope, and resulting conclusions must be agreed with the consultant. So, normally this is, we ask the question and the consultant comes back with an answer, and we accept the answer. But an interesting aspect of this is that the resulting conclusions must be agreed with the consultant. So you don't have to agree with the first bounce response, but if you disagree, then you've got to talk about it with the consultant and say, well, despite what you say, I think that such and such and such. And you have to get the consultant to agree. It's the way I read the standard. I'm not sure it was supposed to be quite that black and white, but that's the way I read it. It's up to the audit team to make sure that the consultant is given all the relevant facts. This is in the perfect world. We draw together all the relevant facts and deliver them to the consultant and say, what do you think? Normally, of course, it's a phone call or an email that says, here's the question, what's the answer? Sometimes with very, very little in the way of background to the situation. The consultant must have appropriate knowledge, has seniority and experience. So you might have a very, very knowledgeable but very, very youthful expert on tap, but they won't do as a consultant because they won't have the seniority. This is, I guess, so that they their word is to some extent deferred to, not accepted slavishly, but there's some kind of recognition that they've been around and they know a thing or two. So they have to have experience. And the consultant must be independent. I'm not sure if the consultant is specifically a member of the audit team, but I think there's no harm in assuming that he or she is. And those who've asked for advice from Topisa Limited on specific assignments specific identified assignments, you will normally get an independence confirmation in the email you get back. It's actually part of my email signature file, and if independence is not required or the client's not identified, then I delete it. But I think it's important that I give you the opportunity to put on file the fact that you have ensured the consultant's independence. Okay. If you know that you're going to be using a consultant and you feel they're going to be sufficiently involved, it's not at all unreasonable to invite them to the audit team planning meeting as a member of the audit team. When they are not in the office, this can be a bit difficult, but we can have electronic participation, that's fine. And otherwise, the consultant has to be given, or should be given, things like the audit risks identified that relate to their work. This is, in practice, a bit unnecessary, but still. Now, a management expert. Well, what we have to do, and this is the slide that we got from a previous webinar, is to evaluate the competence, capabilities, and objectivity of that expert. So we don't just say, management's got an expert, fine. We have to say, is this an appropriate expert? Is it a reasonable expert to recruit? Then we have to understand their work, and we will look at this in some detail. And that's not just saying, they're a valuer or they're an actuary. We actually have to look at the scope of their work and what they've done. And then, this is a sneaky one, we've got to evaluate the appropriateness of that work as audit evidence for the relevant assertion. And this is something that involves reading the expert's report and prodding it for weaknesses. We'll have a look at this in more detail. So, when should management be recruiting an expert? Well, audit should consider the nature, scope, and objectives of the expert's work. Now, this means that if there is if it's an external expert, and remember that the management expert may be internal, may be an employee, but if it's an external one, then there'll probably be a contract or an engagement letter, and we should make sure that that doesn't have a clause that says that you are required to produce a value of our building that is not less than $2 million or something like that. That would concern us as auditors quite considerably. We have to consider what management influence, management may have over the expert. And this is where internal employee experts lose out badly, because of course their job is on the line if they don't keep management happy. And so we've got a serious objectivity problem because management can exert influence. But that's not only employees. I was once in a group that was entertained by an account of the dialogue with, I think it was a forestry valuer. It was a valuer for some important asset. And on the surface, this expert was entirely independent of the client and had a history of doing this kind of work, had proper expertise. But in discussion with the auditor, there were comments about how Charles, the CEO of the client, wouldn't be happy if the discount rate was anything greater than Y%, when it probably should be really. But anyway, we've used Y% to keep Charles happy. And so whilst there wasn't anything formal, it soon became apparent to the auditor that that management was indeed de facto influencing this expert and their opinion. Does your client have controls over the expert's work? That's controls to ensure its suitability and accuracy. It might be controls over the quality of information provided, internal accounting controls and other ways that the organization can be sure that they're using the expert's work properly. And we have to consider, are there professional or some kind of other performance standards for the expert's work? Now, if they are a professional valuer, then the Valuers Institute does have professional standards, performance standards, and the valuer's report should refer to those and assert compliance. If the expert is not a member of a professional institute, it's perfectly reasonable for the auditor to say, well, how do you ensure good quality work? What is your what are your internal quality control methods? And this is the kind of question that auditors have not been asking in the past, and that the FMA have been shaking their heads over, because they think that auditors should be asking this kind of question. And of course, we should consider our own expertise. If we know something about it, we can happily audit the expert's work. And we might have some previous knowledge of this particular expert. So this expert may have done this valuation in previous years, and we studied it and we built up a certain amount of confidence, or possibly a lack of confidence. We hope not, though. So, competence, capabilities, and objectivity of the expert. How are we going to determine that? Well, there are some things like qualifications. Does the expert have professional qualifications? And I mean, when I was in practice, if I saw a valuation of land and buildings and it was a member of the Valuers Institute, I would say, yep, wow, they're qualified. Because why? They printed it on their letterhead. This may or may not be sufficient. And in the current world, we can easily do a bit better than that sometimes. Does the expert have a knowledge of the related accounting standards? And I noticed that most property valuations now do refer to if it's property, plant and equipment, to NZIAS 16, and if it's investment property, to, again, the investment property standard. So at least they claim knowledge. But I saw a number of audit files in the wake of the Christchurch earthquake, and where there was property, the property valuations almost invariably displayed a lack of knowledge of the related accounting standard, because they valued the property at its restored value, because they would check that indeed it had insurance cover, and they would say, well, by the time the insurers have coughed up and we've paid and we've done the remediation that's required, then it will be worth whatever it might be, $1 million. Now, under the New Zealand equivalents of international financial reporting standards, there are actually two separate assets. One is the building as is, and some of those buildings were worth probably nothing as is because they were red stickered and couldn't be used. And there's a separate value, which is the insurance receivable, and that could very well be a large number. But these are different assets with quite different characteristics. Now, the physical building itself, there is no credit risk. The insurance receivable, if the insurer or the reinsurer falls over, we have a risk that will never get paid out. Now, the insurance industry as a whole is sufficiently well organized that that's pretty rare. But nonetheless, it's a different kind of asset. And these valuers were writing out their valuations, assuming that the fair market value of the building was the building plus its associated insurance asset, and clearly demonstrating that they didn't know the accounting standards. And alas, a lot of the auditors didn't know them either. So there was some sadness there. And consistency with other audit evidence. So, and this is another reason why we have to read the report, because I've seen things like forest valuations that quote the log price at a certain historical date, well before balance date or well after balance date. No, we want the value of that forest at balance date, and I don't know how to value a forest, but I would imagine that looking at log prices after that balance date is cheating. And are there threats to that expert's independence, especially if they're an employee? Now, as auditors, we can't change that, but we can look around, are there safeguards? So an employee might be a registered valuer, there will be professional standards. This is a safeguard. But it does weaken the reliance that audit can place on that expert. And then we might get our own expert and get their opinion. So recruit our own expert, say, what do you think of management's expert? We have a case study later that will possibly throw this up. And then we have to understand the expert's work. Things to consider, well, first of all, are we competent to evaluate the expert's work? Now, I know one of my best friends at school went on to become an actuary, but I didn't. Does that mean that I can read an actuary's report and say, wow, yeah, that's fine? Of course it doesn't. So I know the general principles of insurance, and I might be able to read an actuary's report and understand it and say, okay, that's reasonable. But I don't know if it would be best practice or if there's a better way. So we have to be, consider, well, actually, are we able to evaluate the expert's work? So what are the terms of the expert's contract? The terms I've seen are normally being absolutely vanilla, bland, nothing contentious at all. But yes, I have seen some terms that raise an eyebrow, and they had to be discussed with management to see if they. Fortunately, I don't remember one where the terms of the contract actually had an effect on the ultimate valuation, but we've got to understand this. And then this is an important one. Are the expert's assumptions reasonable? Now, you'd think they would be because they're the expert. But I have a tale later where the expert's assumptions turned out ultimately to be unreasonable. And then, how reliable is the expert's data? What's the expert relying on? Is it government statistics of property sales? That's probably pretty reliable. It might, but is it based on internally generated data? For example, suppose we are auditing a mining company, and the mining company recruits an independent expert to value their mining licenses. And I believe this is based more or less on working out how much exploitable ore is in the ground there, and how much it's going to cost to get it out and what it's worth. Now, how does the expert know that there's any mineable gold or aluminium or whatever in the ground? Well, because the mining company has provided the expert with the results of their test drilling or something. That's internally generated data, and the auditor has to exercise professional skepticism, but since it's not actually practicable to go in and well, I don't know, I've never audited a mining company. Is it practicable to go in and reperform a couple of test drills? But what we have to do is not simply accept that data without considering it. We have to look at it and say, how reliable is it? Have we read all of the expert's report? I found some sneaky things buried in small text paragraphs, like no liability accepted to anyone but the client. If I base my audit opinion on this expert's report and it turns out to be wrong, I can't sue them. But someone will probably try and sue me. You might want to consider whether that affects the amount of reliance you can place on that report. So, as evidence for the assertion, look at the relevance and reasonableness of the expert's conclusions. They're normally on the button, but remember those Christchurch property valuations when they were absolutely worthless. They were valuing a repaired property, not a property in the condition it was currently in. Significant assumptions, we'll keep coming back to this one. And the methods used, have they used appropriate methods to do this valuation? I've got, sorry, I'm sorry, there's chat there, I haven't. So we've got some, I do apologize. Data valuation can be within 3 months of balance date either side. The valuation is, the reporting standard, reporting framework probably wants fair value at balance date. Now, the valuation may be done near to balance date, but I, as auditor, would then want to look at, say, the major assumptions and say, is there anything here that has changed between the date of the valuation and balance date? Most valuers use average rolling quarterly prices. As far as I know, that's okay. I'm not a forest valuer. Do you have to independently verify valuers' qualifications? You don't have to do it, but you have to think about it. You want, now, it's a bit like professional skepticism. The more important it is to the audit, the more the more you have to use audit, more detailed and thorough and challenging audit procedures. Yes, you can confirm with the Valuers Institute, and we're going to look later on that. Does not everyone in the business contracts disclaim responsibility? Well, yes, but if I have a choice between, and I have seen valuers reports that said that, or letters to the auditor saying that we acknowledge that you will be relying on this report. Dear auditor, we enclose a copy of our, confirmation direct. So it's a copy that's not gone through management, it's come directly from the expert, and they acknowledge that you will be relying on it, and therefore I think accepting some kind of liability. If they do disclaim liability, then you have to say, can I place as much reliance on this as one where they're accepting liability? And my personal feeling is that you can't. Do I see the use of experts becoming more common with the need of audit statement of service performance? I hadn't thought of it. Most of the organisations where I've seen a statement of service performance, the service performance that's been reported has been fairly simple to, it's been counting things like how many of a such and such did we do. So if we are assisting families of children with cancer, how many families did we assist? And yet there are membership records, which we don't need an expert for. How many grants did we make to oncologists to attend important overseas conferences? Easy enough to add up. But there must be many, many statements of service performance that I have not seen. Interesting question, Stephen, thank you. There may indeed be more use of experts consequent on the statement of service performance, but it will depend very much on what people start to report. Okay, back to the slides. So I have two screens here, and I've been looking at the screen with the slide on, not the screen with the webinar controls on. I apologize for that. Right, so yes, methods used. Now, I know broadly what an actuary is supposed to do, and I have some ideas about how I might do it, but I don't know what good actuarial methods look like, and so how can I tell? Well, they've got a qualification, and depending, of course, on how vital it is to the audit, I might want to get my own expert to say, yeah, that's the way I'd do it too. And here, source data again, relevance, completeness, and accuracy. Now, in my day, when I was a young auditor, you got a valuation report, put it on the file, and you can check the number on the back page and the number on the back page, if that was the same number as was in the accounts. That was the end of the story. Absolutely not these days. Is it consistent with other audit evidence? We've got a case study on that. And how is it reflected in the financial statements? So that's not the expert's issue. That's how the client has used that expert's information. And interestingly, reading some valuation reports, there have been things, some uncertainties that I have felt were sufficiently significant that a little note to the accounts was in order, which the client had, for some reason, not put in it. So, bit of thinking. And we're going to have, what do we think? Can an expert be a management's expert and an auditor's expert at the same time? Whoops. Find the right poll. There we go. You should be able to see it now. So, what do you think? Can an expert be management's expert and auditor's expert at the same time? And we've got some very rapid responses there, and we've got okay, it's leveling up now. The ones who were first on the mouse all went the same way, but oh, okay. Oh, this is interesting. It's close. Oh, I think everyone's got to vote on this one because it's going to be very, very close. Goodness me. Oh, yeah, one is pulling just a little bit ahead now, but it's still not. We've got, apparently we've got 26 connections and 21 votes, so there's 5 who are still unsure. Go on. Give it a go. No, 4 more. 3 more. Okay. Well, okay. They're determinedly non-committal, and in fact, the 3 wouldn't make a difference. So we'll end the poll there and see that. Well, that yes, by a small majority, 14 to 9, think that an expert can be both a management's expert and an auditor's expert at the same time. Now, this is an interesting one because, strictly speaking, they can't, because an auditor's expert is defined as not a management's expert. But in practice, management and the auditor have often, and still do often, rely on the same expert. So, we will get back to the screen. And now, so think about it. Use the chat, use the chat and suggest in which circumstances might an expert be de facto, never mind what the standards say, if we want to split hairs, but where could one expert be de facto management's expert and auditor's expert? And so see what we think about this one. What have I got to do? I've got to so, okay, property valuation. Let me. Someone who says no, it can't be done. A property valuation. What are the circumstances? If the opinion is peer reviewed by someone else, now actually that would peer reviewed by whom? Because one of the things that an auditor's expert might do is not prepare a complete other actuarial report or complete other valuation, but read the management's expert's valuation and say, hey, that's a reasonable basis, or that's a rotten basis, or those assumptions are very good assumptions, or those assumptions are pretty wobbly assumptions. And that's a peer review, but that's by a separate auditor's expert. Okay, we had, by a slight majority, we said, this is talking in practice, not in, as I said, in strictly according to the standards. No, you can't have one expert who's both. But if we are going to rely on one expert, what might have to happen? What might make the bending of the rules so modest that it doesn't matter? Well, things like, we voted for it, but we now can't think what the circumstances might be. So what about if the related risk is not too high? If the auditor can instruct the expert, hey, yes, now that I think is getting there. If the auditor can communicate and instruct the expert in some way, even though the contract is between management and the expert. If the contract says you will follow the any further instructions of our auditor. That, I think, is one way to kind of sneak around it, because we're going to see there are a lot of things the same with an auditor's expert, but there are also quite a few things that are a bit different. So I think it's, how important is this that we be squeaky clean? What are the numbers that are riding on this? Is it something where where the audit team has within itself got a reasonable amount of expertise and can reasonably peer review? I was on an audit once where the previous year the senior had a quantity surveying qualification, and it was a very useful job to put him on, because the major part of the stock was a raw material that was delivered by ship, and it wasn't in containers. It was bulk, and it was simple. And they used the grabs to hoik it out in the ship, swing it around and dump it on the storage area. Was right by the wharf, and it was fascinating to see how he approached this. He'd taken photographs and approximated this a very irregular heap of stuff. He'd approximated it to regular geometric shapes to work out the volume, and then he'd done something or other to estimate the weight per volume. Anyway, and which included allowing for the fact that those at the bottom being crushed down and would be denser. That's the density. So the year I was the senior, we didn't do that, and the partner was perfectly happy. Well, I'm thinking if I went and did that audit again now, I wouldn't be happy with that approach to stock. Right, where are we? Let's go back to the slides. Okay, now, auditors experts, ISA NZ 620. And the important bits, the most important bits, are that the auditor has the sole responsibility for the audit opinion. So it's no good saying, well, we employed an expert and they got it wrong, so it's not our fault. Or the auditor or the expert said, no, that's fine, so we gave our opinion. No, it's our opinion, and we have to decide whether or not to use an expert. Do we have sufficient expertise for this assignment? And then, having decided whether or not to use an expert, audit has to determine if the expert's work is adequate. Well, hang on, but that's what we've got an expert for. So what do we have to, and where it comes up yellow, this is different from a management's expert. So as auditor, we drive this. We tell the expert the nature, timing, and extent of procedures. You have to report to us by, boom. That's up to us. Audit is driving this, and that's not what the case with a management expert. Again, we have to look at the competence, capabilities, and objectivity of the expert. We have to understand their field of expertise. We have to have agreement with the expert. It doesn't have to be a written contract, but most experts will issue an engagement letter. But there has to be some kind of agreement. That's, and how do we can hardly have an agreement with management's expert because management has chosen them. And again, we have to look at the adequacy of our expert's work. Well, why am I employing an expert? We will see. Okay, nature, timing, and extent of procedures. It depends on related risk. So the extent, particularly, how risky is this? Again, do we have experience of this particular expert in the past? And what about quality control procedures? We have to consider. We don't have to impose them, but we might want to. But we might very well want to say, well, what are your internal quality control procedures? And fascinatingly, an external expert is not a member of the engagement team and is not subject to PES3. So an internal expert, and truly, some audit firms employ their own actuaries and valuers. And of course, lots of firms employ their own tax experts. The internal expert is a member of the engagement team and is subject to PES3. An external one, we go outside the firm, no, but we may insist on certain QC procedures. We might ask if it's a property valuer, and if it's one of the larger firms, they possibly do have some very similar quality control procedures. I don't know. I never asked when I was in practice. It wasn't a done thing. But and if we're using an internal expert, audit may generally rely on the firm's quality control system. And innocently, one day, I asked an audit partner in a national firm, how did they identify an appropriately qualified tax expert within the firm? And the audit partner couldn't answer the question. So I was invited to pose the question to the head of tax for that firm, and the first time it was posed, it got lost somewhere. But anyway, I remembered it some months later and tried again. And the answer, interestingly enough, was that if the individual is described on the firm's website as a tax expert, then they are a tax expert. And that was the, I was expecting, they would have had to have, so many years experience and possibly done special tax exams. No, it's if we have so much confidence that we describe them as a tax expert on the website, they're a tax expert for audit purposes. Interesting. So, competence, capabilities. Look, this is very much the same as for management expert. The information may come from experience, from discussion, qualifications, published work. So are we employing someone who's actually written a textbook on this kind of valuation or work? Technical performance standards. I'm following actuarial standard 1, 2, 3, 4. Is it a specialist? I'm a specialist in investment property valuations. Knowledge of accounting and auditing standards. We have to inquiry threats to objectivity. We don't. So we actually might very well send them a little questionnaire on independence. Absolutely fine. And it is best practice. It's not actually compulsory, but I would say it was a really good thing to obtain a written representation re-objectivity, to say, to get our expert to say that they have not got shares in the client, or and so on, because we want them to be as independent as an auditor, because they are, part of the audit. So, case study. We have decided that we are auditing a property investment company, which has one property, and of course that's about 98% of the assets. So, how would you, just briefly, go about assessing the valuer's competence, capabilities, and objectivity? What do we think? Okay, we want to employ a valuer to value a very, very significant asset which has probably been, in practice, it will have been valued by a management expert, and we would probably want merely to peer review that valuation. But we still have to assess their competence, capabilities, and objectivity. We have to. And you can't actually say that's a silly thing to do. And in fact, with one of my clients, we had a fascinating conversation around the suspected incompetence of a management expert. But the management expert had all the right tickets and qualifications, and even claimed specialty. So how will we check this? Well, we'd look at, is our expert registered with a body, a member of a professional body? Yeah. Check their resume to see what expertise he has and in which industry he's doing valuations. Very, very sensible ideas. Look at is he a member of the professional body? Does that professional body have some kind of quality assurance regime? And ask for a reference. Yeah, you can do this. You don't just have to, perhaps too, you don't just have to go to the yellow pages and pick a valuer. You can say, have you done this kind of work before? Yes, of course, lots of it. Who did you do the work for? And so, yes, I've done that for other auditors. Okay, who? Would they provide a reference? It's just what you do for an important employee, or even possibly an unimportant employee. Request direct confirmation from the valuer. Dear valuer, are you competent? No, what you mean is, please supply me with details of your professional qualifications, and maybe a summary of your continuing professional development in the last 24 months, that kind of thing. Yep. What else might you do? Well, okay, well, we will now have a look at, if I can, right. Now, hopefully, you can see the Property Institute website there and find a property professional. Click here. I'd be interested to know if anyone's actually done this. And look, specialty. We can now, wow, it's probably a commercial industrial property. If it's an investment property, but it might not be. It might be rural, it might be residential. Let's suppose it's commercial and industrial. City will say Nelson because that's near where I am, and it means we won't get too many. And wow, we've got 9. Actually, we've got 8, and Ian McKee is listed twice. I don't know how that happened. So these are people who hold themselves out as having that particular specialty. I don't know who decides that specialty. It might very well be a self-declaration, but nonetheless, these are people who are holding themselves out as being specialists in that area. And if we've got someone who says they're a specialist and they're not on this list, there's a question there. And I have to get out of it. Objectivity, do they do any work for the client or a competitor? Absolutely. Excellent question. Thank you, John. Excellent suggestion. And we will go back to this. And okay, no, I've got now find an accredited firm, and this was quite interesting. List of accredited firms, and there they're listed by just their names. And we'll have a look at Duke and Cook. And Nelson's longest established property consultancy practice. I haven't asked who wrote this, but it looks to me as though it's probably written by the firm. So that kind of discounts how much weight I can put on it. But it goes through to their website and, oh, hurry up. And reputable, fully accredited. The Property Institute does have an accreditation scheme. Now, preparing this, I only saw that they've got one. The Institute thinks it's a really good thing, surprisingly enough. And it's certainly better than nothing. So there are a number of things that we can do. And this is just the property valuers. There may be the same for actuaries, forestry valuers, don't know. But this is the kind of thing that technology allows us to do. Back to the slides. Got that one. Okay. Now, the expert's field of expertise. Oh, yeah. We determine nature, scope, and objectives, evaluate the adequacy of that work. Assumptions and methods are appropriate. Yeah, oh, we've seen all this before. The nature and reliability of the data used by the expert. This keeps coming up. And agreement. Now, this is what you don't have with a management expert. So, agree on what you're going to do, when you're going to do it, and who does what. Now, if we are reliant on clients-generated source data, who's going to test it? Is that going to be the audit team, or are we going to rely on the expert to establish the the reliability of that source data as well. And you might want to make clear who's going to own the expert's working papers and so on. So who's going to do what? Nature, timing, and extent of communication. So keep us involved. Final report must be by. And interestingly, that's a specific in the standard. The need for confidentiality. Most experts that would be an automatic, but we've got to get it in there. And evaluating the adequacy of the expert's work is very much the same as a management expert. Relevance and reasonableness, completeness and accuracy of source data that comes up. Now, what do you do if you think the expert's work is inadequate or it comes up with no conclusion? Well, you might want to agree more work by the expert, because if the work was inconclusive, they may have to do some more and get a bit more money. Or perform additional audit procedures. There might be another way to skin that particular cat. Now, can you refer to an expert in your audit report? Well, of course, in general, no. If the opinion is an unmodified opinion, you do not refer to the use of an expert. If the opinion is modified, you may need to refer to the expert. So it might be that that we were unable to, we employed an expert valuer to peer review the client's value of its investment property, and our peer reviewer disagreed with a number of the assumptions but some of them would move the value up, some down, so we could not form a clear opinion on what the valuation or whatever it is. You might have to say that to explain your modification, but that does not reduce the auditor's responsibility for that opinion, and that has to go into the audit report. So what has the FMA found? Well, interestingly, there was damn all in the 2016 report, but quite a lot in 2015. So let's hope that this means that licensed auditors are getting it right. and this was an interesting one. Firms failed to assess the competence and capabilities of the expert. But they did, it was acknowledged, they did confirm independence and qualifications. So, yeah, they did confirm, yes, this person's got appropriate qualification, he's a member of the institute, and yes, he is independent, but is he actually competent to do this particular job? Does he have the right specialized knowledge? They didn't yet. And the FMA noticed that experts' reports contain significant disclaimers regarding information or reliability of data used or conditions that weren't met at the time of the valuation. And the auditors didn't pick that up. They didn't read the report closely enough. They didn't join the dots and say, oh, well, maybe we've got to do something else here. The impact of these disclaimers about reliability of data were not addressed. The audit firm didn't engage its own expert when management's expert used complex methods in an unfamiliar industry. Now, this means that FMA expects the auditor to go out and get its own expert if the audit team is not sufficiently skilled and familiar with the industry to properly evaluate management's experts' work. So the FMA actually expects auditors to do that. The auditor didn't test the significant source data used by the expert. Yeah, I've been guilty of that. Yeah, I got the audit, the report, and yeah, just put it on the file. The number at the bottom is the right one. Now, in forest valuations, I've read quite a few where the valuer said that the health and growth of the trees was based on representation or reports done by the forest manager. And the forest manager was utterly non-independent. The forest manager was also the preparer of financial statements. And that's, is that reasonableness of source data used by the expert. And sometimes, and unfortunately, this wasn't illustrated with an example about the scope of the expert was limited, and the audit team did not address the remaining requirements of the standard. So this, I suspect, is that T's weren't crossed and I's weren't dotted, and of course FMA reviewers are famous for requiring all T's to be crossed and I's to be dotted. So that's what the FMA found, that auditors weren't doing it quite right. So what does FMA expect? The main area for improvement is team evaluation of the adequacy of the expert's work. And this might be simply actually writing it down, that we have read the report and the methodology seems appropriate and the source data is reliable. FMA expects to see significant involvement from both the engagement partner and EQCR. Well, they expect that for, and reasonably so, for any areas where there are major risks. And this is the expensive one. Where businesses have significant valuations that require significant industry expertise, we expect the audit firm to engage its own expert to assess the relevance and reasonableness of the key assumptions. Any forestry company or forestry partnership, the largest asset will be the trees, almost inevitably. And that does require significant industry expertise. So the audit firm has to engage its own expert. Now, there may be an internal expert, someone who's audited many forestry companies and partnerships may be an expert. But if they're not, then the FMA expects you to go out and hire one. And we expect the T's to be crossed and the I's to be dotted, and all the requirements of the auditing standards have to be met. Super. Okay. Right. Here's a scenario. This is a real life one from a couple of years ago. A forestry partnership reports its trees at fair value as determined by an independent valuer. Valuer indeed was an external valuer. And the value has risen 50% since previous balance date when those trees were valued by the same valuer. Now, quick question, would you accept that valuation as is? And I've got to run the poll. So, yes or no? There you are. Same value as last year. Trees, the value has gone up 50% in the year. Would you accept that valuation as it is? Quick, whoa. What? A professionally skeptical bunch. I think I can probably Finish. I think anyone who's going to vote yes on that it would be a prank. Okay, we have 100% no. Yeah, I cut it off after 17 votes. 17 no's, no yeses. So get back to. So, what additional procedures would you employ? We're going to have to be quite quick on this. So, and we'll give it a couple of minutes, and then I will tell you what actually happened. So, we don't like the management's experts valuation. Okay, we would start by reading the report. We do everything that Bill just talked about. Of course you would. Review market data and other assumptions. Yeah, yes. Look at the assumptions. Yes, look at the assumptions and the source of the data. And you might compare the assumptions to last year as well. The discount rate and the log price. Yeah, you can probably find the log price somewhere. Ask the expert why it's 50%. The expert will just say, well, that's how it came out. Many valuers reports now show a section explaining movements from the prior year. I don't know if that particular report did, but it's a good question. So what actually happened was that the auditor got in touch with, yes, here we check results of other forestry partnership accounts are similar results shown. Give the man a gold banana. That's exactly what the auditor did by contacting another auditor who audited quite a few forests and said, are you getting 50%? And the answer was no. Ours are averaging out at about 15%, 1.5. So they decided that this could not be a reasonable valuation. So audit employed their own expert and yes, Cameron, you remember it. Audit employed their own expert who peer reviewed the first management's valuation. And the results were quite interesting. He said that the assumptions, the underlying assumptions were not actually unreasonable, but they were all at the edge of the reasonable range that would maximize the value. So here's some key assumptions, and this one, they're all right at the far end to maximize the valuation. So fortunately, the client was accepting or was persuaded that this essentially meant that their valuation could not be relied on, at least by the auditor. And another, I think it was probably the auditor's peer reviewer, was retained to prepare another valuation. And that knocked a couple of $1 million off the value of that particular forest as reported to the owners. Last, okay. And the client's view. The clients, of course, are absolutely thrilled and delighted that they are now being expected to pay for a second expert to assess the work of the first expert. Have you noticed this? I'm sure all of your clients that are employing experts think it's great, but in actual fact, that's what auditing is all about, because The client employs an accounting expert to prepare financial statements, and the auditor comes along as another independent expert and prods it for weaknesses. And we're simply taking this into the work of the experts, not just the accountants. Yeah. So, what you might like to think about is, what will you do differently in the future about your reliance on experts? And you can think about that while I'm changing to the other slides for the questions. We've changed. No. Okay. Now, do we want questions about poker machines, or yeah, we better do that. Questions, poker machines. We probably know that the operator of poker machines must be a corporate society, but I've had a couple of questions recently that were around this. And the operator must hold a Class 4 license from the Department of Internal Affairs. Now, what people don't all know, I mean, everyone knows about poker machines being operated, needing a license to operate them legally, but if you hold a license, you have to prepare accounts in accordance with GAAP, generally accepted accounting practice. And I gather from more than one source that this has not been happening. It's Section 108 of the Gambling Act, and that's the law. And you might not like the way the law's been written, but that's it. If the Department of Internal Affairs has been accepted, it seems to, lots of people use the Institute's SPFR, Special Purpose Standard, which of course is for for-profit entities, and poker machine operators are not allowed to be for-profit entities, as I understand it. So if the DIA continues to accept the wrong kind of accounts, I guess that's okay, but the auditor cannot agree with the framework adopted. So it's not-for-profit tier 3, because tier 4 is a non-GAAP standard. Unless expenditure is over, and that's including profit distributions of profits. Expenditure is greater than $2 million, then we're into tier 2 IPSAS reduced disclosure regime. That's expensive. NFP tier 4 doesn't count. It's a non-GAAP standard. So it doesn't matter how small the operator is, they've got to do GAAP accounting, which is tier 3. And of course, that is includes a statement of service performance, and they might like to report on how much they've distributed to community groups. And the statement of service performance. A few observations here. The statement of service performance is an integral part of the performance report for tier 3 and tier 4, not-for-profits. So if we are auditing the complete performance report, then the statement of service performance is part of the audited report, and it's not other information. So if it's a charity and their expenditure is over $1 million, then they have to have an audit. Then we have to audit the whole thing, including the statement of service performance. But a lot of non-charities are using tier 3 and tier 4 reporting. And some charities are so small they don't need an audit or a review. So if their expenditure is less than $500,000, then they might be producing a complete Tier 3 report, but only having the financial statements audited, because that's what the Constitution or the rules say. If we're only auditing the financial statements, then the entity information and the statement of service performance are part of the annual report, the performance report, together with the financial statements, and are therefore other information presented with the financial statements. So your audit report has to refer to that other information in an other information paragraph. Isn't that good to know? Isn't audit reporting getting weirder and more complicated? I think there should be a completely separate qualification now in audit reporting. So we should have auditors who actually do the work, and audit reporters who do nothing but compose audit reports, because they're now so complicated. You don't think that's a good idea? Well, no. So, my screen's gone odd. Yeah, that's what I was expecting it. Well, I wonder what you got. Anyway, that's the end of the material for the webinar series, and it's the last of the questions. We have a little bit of time left, and just in case, I have some slides that a list of mistakes that you would never make, but which I have, alas, seen in real live audit files. One or two of you may have seen this material before, but what I think I'll do is I will conclude the webinar now, because it's very, very nearly 5 o'clock. So those who have to rush off home or go to a 5 o'clock meeting, or go back and edit an audit report, they can do that and feel that they've attended the complete webinar. But for those who have a few more minutes, I'll quickly run through these mistakes that you would never make, and I don't know quite how they got made, but they truly did, because I've seen them. So those who are departing, farewell. And we have a question. So I have to. So for a Tier 3 single audit opinion on financial statements, does that mean reference to the SSP as other info? Yes, that's exactly what it means. So if it's a Tier 3 performance report and the audit opinion is only on the financial statements, that means that the statement of service performance is referred to as other information, which we specifically say we have not audited. A registered charity, yeah. Okay, right. So I will, for those who are fascinated and don't have anything special to do in the next 10 minutes, I'll run through these things. You will probably be thinking it's going to be amusing. In fact, it's horror. It really is. Quickly through these. Inherent risk, control risk, and detection risk, all recorded as low. I've seen this actually quite a lot. and it guarantees that the auditor does not understand the risk equation. Because of course, if inherent risk and control risk are genuinely low, then detection risk can be set as high. And in most cases, the control risk was high going on extreme because these were very small organizations with no controls at all. No search for related party transactions. Sorry, for a long time now, that's been a compulsory part of the audit. You don't just say, oh, are they, excuse me, presented correctly? You've got to put a stick in the bushes and flush them out. Analytical review. The entire analytical review on the file was this year versus last year. The numbers were written down, no comments, no follow-up. That's not analytical review. Risks identified, but not actually addressed. Can you believe it? And I've seen, in some cases, they were really quite good risks, you know, intelligent risks. So, oh, good, I wouldn't have thought of that. What did they do about it? And nothing. Work done that does not provide useful evidence. Yes, it doesn't. That's not common, but I've seen a few. So, this is why. Why are we doing this? Incomplete testing. You wouldn't believe it, but detailed testing work papers, and we've selected however many, 10, sample of 10, sample of 15, 20, and we've tested maybe half of them, or we've tested some aspects of all of them. I truly have seen that. Big detailed test worksheet with gaps in it because, say it was expenditure testing. For this one, it's been coded correctly in the ledger, but we couldn't find a supporting voucher. And it's just been left there. In one case, there was a conclusion on the work paper. It said fairly stated. Errors not followed up. You have to be brain dead. You find an error and you tell the client, please fix it. And no legend for tick marks. This is actually quite common. If you worked for me, you could get fined for not putting a legend for your tick marks on the file. Fine was a chocolate fish or a coffee at the option of the reviewer who found the sin. Same penalty for having no conclusion on a work paper. If we've done some audit work, we have to have learned something from it, even if the conclusion is the control doesn't work. Obviously incorrect financial statements. Now, occasionally I have been presented with an imbalance sheet to audit, but it's always been spotted and fixed. Yes, I have seen an audit opinion attached to an imbalance sheet. Obviously incorrect audit report. One dead giveaway was it was an old style audit report, some years out of date, which meant that I think it was the change from New Zealand's codified auditing standards to the IAS's. That auditor had told the informed world that they weren't up to date. Audit reports signed before the accounts. You would think that a number of times auditors, most auditors spend a lot of time making sure they get the date right, but I've seen audit reports signed before the accounts. I have seen the audit report signed by the senior. The situation was that it was a two-office practice, and the audit partner was in one office, and the audit was done out of the other office. And the audit partner phoned up the senior, or the senior phoned the audit partner and said, well, we've got the final accounts in, I checked them, everything's fine. And the partner said, oh, well, you'd better sign the audit report then. I found this as an institute reviewer, and it was actually quite a difficult review report to write because it's so obvious that the engagement partner signs the audit report that it's not in any of the auditing standards. But the audit report has to be approved by the audit engagement partner, and there was no evidence of that on the file. In fact, in that particular file, there was virtually no evidence that the engagement partner had seen the file. Audit report not signed at all. Oh, did I have to? A clean audit report when material errors found. And they were even on an error schedule. You know, well, why do we have an error schedule? But, oh, no, we finished the audit, so we issue our audit report. And this is truly the entire risk assessment. It said, reviewed income and expenses for November, low risk. And you will be staggered to realize that this was the audit of a chartered club. It did have a bar, it did have poker machines, and the audit file, when you got into it, made quite a few references to the fact that the manager of the club concentrated lots and lots of duties. And this was called low risk. Interestingly, one of the payments selected for testing was a round sum paid to that manager without any supporting documentation, which was one of many queries that the audit senior recorded these as queries, and some of them were cleared, but a lot of them were just sitting there still on the file, and the audit partner had signed off. Acceptance work done too late. Yeah, we accept an audit after I've seen acceptance work dated the same date as the audit report. No, we have to accept the assignment before we start substantive work. And for a recurring engagement, I don't know what regulators think about this, but my view is that in truth, we accept next year's assignment when we complete this year's. So why not do the reacceptance, document the reacceptance at the time we finish off this year's file for next year's audit? Because that's when we've actually made the decision. And oh, this was a wonderful one. It was a firm in a provincial town who persuaded some of their clients that a review engagement would be less work and less fees than a full audit, and they didn't need a full audit. And they were quite true. It was, the clients they offered this to did not need a full audit. So the clients said, oh, okay, we'll go for a review engagement. And they got a review engagement report, but they did exactly the same work for the review engagement as they did for an audit. And the prize for the most dumb thing I have seen on an audit file was the material. There was a planning work paper, and it had boxes for this, that, and the other thing. And the box for materiality had in it the word yes. And I wish I was making that up, but no, it's the absolute truth. And the auditor was at least properly embarrassed when I asked him about it. So there, some of the things that you will never, ever, ever do. And it's now 5:10, and it's probably time for us all to shut down our computers and go home. So thank you all very much for joining me in the summer webinar series. Oh, hang on. Stop the sharing. Yeah, I've enjoyed writing these webinars and presenting them, although it's been a little bit scary sitting in front of a computer and trying to talk for an hour and a half. I don't think I will go for a job as a radio announcer. And if you think this haircut is wonderful, you can't have seen the picture of it when it was dyed, and the story about how I got tints in my hair. That was it's too long to tell now. So you will get an invitation probably tomorrow or Friday, inviting you to give a bit of feedback. It's optional, but it's very helpful to me. So thank you. Yes, we have been recording, and you will get the link to the recording tomorrow. Thank you too, Dennis, for joining us. Okay, all the best to everybody, and it's good night from him. Bye.